Hi, and welcome to this short presentation on the chapter of Volatility Smile and Volatility Surface. In fact, in particular, we're going to discuss about a typical problem that has been presented by one of the students in our FRM-Part 2 and has been directly taken from the Kaplan Schwesers book. I read out the problem first. When evaluating the impact of volatility smile on the calculation of option Greeks, which of the following statements is most likely correct? If equity prices and volatilities are negatively correlated, equity price increase will move the option up the existing curve. If equity prices and volatilities are positively correlated, equity price increase will move the entire option curve down. The minimum variance delta will be higher than the Black-Scholes-Merton model delta. Delta, as you know, is nothing but the minimum variance hedge ratio. Sometimes it is also interpreted as beta as well. When equity prices change, the effects from movements in the implied volatility curve up or down tends to dominate movements along the existing curve. All right. Now, before actually I get into the nitty-gritties of problem, let's revisit some of the limitation of the Black-Scholes-Merton model. And in particular, I'm going to isolate these two assumptions. First is the volatility of the underlying asset is constant and is known. Option values depend upon the volatility of the price of the underlying asset or the interest rate. Second is markets are frictionless. There are no taxes, no transaction costs, and no restrictions on short sales on the use of short sale proceeds. Now, for any developed economy where options are freely traded in the capital market, these two assumptions do not hold. In fact, the second assumptions are absolutely farcical in nature. Precisely also the reason that why BSM model will find its relevance in the OTC contracts and OTC options, but not the exchange traded options. In fact, for the exchange traded options, it actually forms the data level, nothing more than that. Now, let me tell you why this is a limiting assumption. So first and foremost, you must understand that when we talk about volatility, the formula of volatility is closely tied with standard deviation. And how do we exactly go about standard deviation? You would already know the formula for standard deviation happens to be xi minus mu square divided by n. If you take a square root of that, that becomes the standard deviation, which in turn is our proxy for volatility. The problem with this is that this standard deviation is always going to be historic in nature, because where are these xi's coming from? They are coming from the price distribution of the underlying assets which have been observed in the past. Now, two things can happen. Either you can assume that this volatility which you have historically calculated is going to remain constant for the foreseeable time or for the time horizon that you have chosen. Or second, what you could do is that you could observe the market driven or the market traded option prices, for example, the real option prices for the call and put, and then feed them in the model, sort of a backtracking or backfeeding the entire mechanism. And from there, you can isolate this n of d1 and n of d2. And once you isolate the n of d1 and n of d2, which are nothing but the cumulative probability, you can always back out the d1s. And from the d1s, of course, you can find out the sigma square or the sigma itself, which is the volatility. Now, this volatility is always implied and futuristic in nature. Okay. Now, please understand that once you have observed the market, once you have taken this market observed prices, and thereafter you take out the volatility, you feel that this volatility is the actual volatility, which you can then use for further pricing the call options and put options. And that precisely where things can actually go on horribly wrong. The second thing was, as we said, markets are frictionless, which is basically, again, a proxy or an alternate way of saying that we are actually in an ideal scenario. When we are talking about traders, those traders all have same kind of information and they all have same kind of rational expectation from the market itself. Only in such a situation, markets can be frictionless. Of course, in market is frictionless, then this traders, that means the buyers and the sellers in this market, are only motivated by the liquidity of the market itself. And in a perfectly liquid market, of course, there cannot be any associated costs, for example, tax, transaction costs, etc., because nobody makes any extraneous money. Nobody has an edge over the other thing. Of course, you can understand that this is a completely hypothetical scenario. It doesn't work out in the real world in any way. So in my considered opinion, these are two major flaws that why the model derived prices for options as we get and the actual option price that we get, they rarely match. The second thing that I wanted to focus upon is that if you take the put call parity from the both market driven and the model driven values, then we will see that to prevent arbitrage, the put call parity must hold. And if we simply deduct equation 1 from equation 2, then we will understand that the error in the market driven prices and the model driven prices are exactly going to be similar as far as the puts and calls are concerned. Well, this also is a mathematical flaw. Why and how it is so, I will come to it a later to a little later on. But the fundamental premise is that the put call parity must hold to prevent arbitrage. That has to hold good in any case. Now let's talk about some of the Greeks, and we start with, of course, you are aware of what is meant by delta. Delta is nothing but the rate of change of the value in an absolute term for with respect to the rate of change of the underlying asset prices. So uh, the delta for call and put are simply symmetrically opposite, and one is n of d1 and another is n of minus d1. That's what it is. And let's talk about the volatility. And the volatility vega is again first order derivative of the option prices with respect to the change in the volatility itself. The expanded formula for volatility can be given as this way: S0 into root over T n of n dash of D1. N dash of D1 is basically the alternate of n of D1. Now, from here, it is clear that volatility or the vega has a symmetrical effect as far as the call and put options are concerned. That means that they're going to affect the call and put options uniformly in the same manner, albeit in exactly a mirror image pattern. You can also see that there is no bias as such. That means vega will affect the call and put option or impact the call and put option always in a similar manner. That means volatility increasing, of course, the option prices will increase for both call and put. Volatility decreasing, all other things remaining constant, both call and put options will decrease in their prices. Now, there are a couple of things I wanted to point out, and I read out. Given the same asset, because here we're talking about the volatility, okay? So volatility of the underlying asset. Now, understand that in a given market, a single asset for a given time horizon cannot have two different volatilities. It is absurd, right? Because if it is so, then arbitrage will definitely come in, just like an asset in a given market in the same time, or even in two different markets, cannot have two different prices adjusted for those exchange rates and transaction costs and tax and etc. etc. Those extraneous costs, if we actually discard, then obviously they cannot have two different prices because otherwise arbitrage will set in. So the same principle follows with regards to the volatility of a given asset. In a same market, for the same time horizon, an asset cannot have two different volatilities. And second is, as we said, that since from our understanding of Greeks, we conclude that volatility is a friend of option and an enemy of option in the same manner. So if volatility rises, it should affect both the call and put option symmetrically. However, I want you to look at the real world. And in the real world, I have now picked up a particular option chain for an index in my country, that of India. And this is the National Stock Exchange option chain. And in particular, I want you to look at these blocks. The blocks highlighted in yellow are the ITM blocks. ITM is in the money. So these are the ITM for the call blocks, of course, and these are the OTM for the ITM for the put blocks. Okay. For the same reason, the white portion for the calls are these are OTM, and the white portion out here up is OTM for put. Now, of course, you can understand that the junction portion out here is where the at the money calls and puts are. The question, the matter of interest is the implied volatility column. So I want you to focus on the fifth column from the left-hand side and from the right-hand side simultaneously. You'd see, and I want you to pay special attention to. So at the money, calls implied volatility is around 12.46. At the money, puts implied volatility is 15.41. Put implied volatility is 15.41. Both of them, mind you, both of them are still pointing towards a single asset, and that is the index of Nifty itself. Okay. And few observations also that is important is that as we move, as far as the call brackets are concerned, as we move from the ITM to the OTM end, we will see that the implied volatility is only increasing in manner. And as we move on the OTM side of the put option, there also we will see that the implied volatility is increasing. Okay. But with put, there is an additional aspect that I want you to focus upon, that as we move in the deep in the money from ATM, we will see that here again the implied volatility is increasing. So these are the real things. So first and foremost, we understand thoroughly from here that all the presumptions and the assumptions of BSM on which actually point towards the asset volatility, they are heavily violated out here. Why? Because again, the underlying asset out here is the Nifty index, and the Nifty index for the given maturity, for a given time horizon, cannot have so many volatilities. It can only have one volatility, and that is fundamentally true, just like it cannot have multiple prices at the same time. So here, of course, the first fallacy is being displayed. The second is, when we say that the volatility affects both the call option and put option symmetrically, that is also flawed out here. We can easily see it. Invariably, the put options at the money implied volatility is much higher than that of the call options, and this will always be the case. And at the same breath, we understand that either side of the at the money, for as far as put options are concerned, the volatilities are only increasing. That means the put options volatility, implied volatility, put options implied volatility for the Nifty index is lowest at the money, while branching out on the higher side, both on the in the money zone as well as on the out of the money zone. Okay. Not so much as far as the call options are concerned. Call option, in that case as well, the at the money volatility, implied volatility is the least, and thereafter we will see that it is, as we are moving to the OTM side, the implied volatility is gradually increasing. Okay. Now, what does this mean? It tells us that if we had taken, and this is very important, if we have taken the observed market prices of the at the money call and put option, because they are the most liquid, then we would have taken the 12.46 as our volatility for call and 15.41 volatility for put. First and foremost, there is an inherent flaw, as I have explained, that both of them are different. It should not be the same. But even if we take them into consideration for pricing the calls and puts of the OTMs, then the prices of those calls and put options, whatever we would have gotten, those would have been definitely less than what is being shown in the option chain. Why is it so? It is because volatility is one of the major determinant of the option prices. And both in case of calls and puts, we see that the implied volatility, by observing the market prices of these options, even in the out of the money, those implied volatilities are only increasing. For put, it is absolutely true. For call also, it is true as we are moving to the OTM side. Okay. So this is again easily understood that volatility is not symmetrically affecting both the calls and put side. Okay. In an ideal scenario, we would want this kind of situation where we will see that, well, it is symmetrical, because this graph seems to be symmetrical. In this, we at least understand a couple of things. One is that the graph seems to be symmetrical, so it should, the underlying volatility of the asset must affect or impact the calls and puts in the same manner. That's one. Second is that the volatility is not constant. We wanted the volatility to be in this fashion, because this would have actually guaranteed the constant volatility aspect of the BSM model, but this is not the case. We see that this is increasing. Okay. The other aspect is that this is an ideal scenario that we would want as far as the symmetry of effect is concerned, but we will see later on that this is even not the case. The OTMs, and I say this, that the OTM calls are and puts seem mispriced. The market observed prices are higher than what the model may imply. How we derive the OTM calls and puts from model, I have already explained. You observe the market price, and from the market price of the at the ATM, you observe the market price, and you take those market ATM values to back out the volatility, and you apply use the same volatility to calculate the model driven OTM calls and puts prices, right? And those calls and put prices, when you compare them with the market driven calls and put prices, even for the OTMs, you will see that the BSA model's calls and puts are invariably much lesser than that of the market prices, which tells us that this can only be possible when the associated volatilities for the OTM options are actually greater than what the market should suggest. In other words, volatility does not remain constant. Now coming to the second and the most important aspect. We understood that volatility does not remain constant. We at least expected them to affect both the calls and put symmetrically. We saw from the exhibit being provided that is even not the case. And we saw that the OTM puts have higher volatility as compared to higher implied volatility for Nifty index as compared to the OTM calls. Why is it so? Which gives us not a volatility smite, but a volatility smart. Now, the question is, why is it so? Three theories have been proposed. Uh, in my considered opinion, all three of them are inadequate to actually address the problem, the why it happens. Okay, but I read out nonetheless. So first theory said that lower stock price makes the position over leveraged, hence the put insurance goes up. It is but natural because, for example, if there is a stock that is priced at 100 and you put in your own equity of 20 and the rest 80 is being borrowed, you pay an interest of, let's say, 6% on this, right? This is your position. Now, if this 100 actually comes down and becomes a 70, then of course you can understand that the lender is going to charge you additional interest or is going to ask you additional deposit because your 20 is just not going to be sufficient to cover the position. Okay, this is what is meant by over leveraged position. So the lower stock prices imply over leveraged position. If over leveraged position comes into picture, of course the associated put options will be much higher valued. In turbulent times, downside risk protection becomes more prominent. And last is, of course, crashophobia, because market participants, when there is too much volatility, market participants actually expect the market to crash more number of times rather than market going up. Because do remember, the classic definition of volatility tells us that it can go either way. But volatility, when it actually increases, participants actually panic. They believe that the probability that the market is going to come down is going to be more than the probability that the market is going to go up. These are three proposed theories. But in my considered opinion, all of the pundits have actually, and the theorists and the practitioners, they missed out one very vital and yet very simple point. You see, when we talk about volatility, and we know for a fact, or rather we assume that the volatility may affect both the calls and puts symmetrically, one, I might have a bet that the market is going to go up. Accordingly, I might take a suitable position in the call options. And who are going to be the major participant in the market in such a position where the market is likely to go up? Yes, you have guessed it right. It is going to be the speculators. Similarly, when the market is likely to go down, there are going to be speculators in the market here as well. However, there is a difference now. If the volatility or the market conditions so suggest that the probability that the market is going to go down more than the market is likely to go up, in that case, along with the speculators, the hedgers will also jump into the fray, because making quick money becomes less important. Protecting the real asset, protecting the portfolio becomes paramount importance. That means that the number of speculators and hedgers are going to be much more when the market is likely to face a downturn risk than the number of speculators when the market is actually going to go up. Because the market actually, when it goes up, there are hardly any hedgers here. Most of the market participants are going to be speculators only. Now, what does it mean? It simply means that the volume of trade for the put options will increase more as compared to volume of trades for call options when the market is likely to face a downturn risk. So, of course, you can understand that in place where there are 100 traders when the market was going up, now there likelihood to be 200 speculators and hedgers put together when the market is likely to go down. And of course, this is going to put an upward pressure as far as the put premiums are concerned. The OTM puts will become more valuable than the OTM calls. Precisely the reason why those prices will go up. And if those prices go up, those OTM puts prices will go up, their associated implied volatility will also go up. And precisely the reason why this graph is never symmetrical, but looks like a smirk. And this is something which has never been explained in any of the books whatsoever, but I have read. Now let us tie all of them to solve the problem or explain the answer as such. You see, we have already talked about the BSM inputs and its limitation. We talked about the essence of implied volatility. We talked about the momentum factor, which is basically the market participants of hedgers and speculators when market is likely to go down. And last, of course, is the time factor. Along with this, let me also give you a little bit of uh, peekaboo into the implied volatility market as far as the volatility smile or even the volatility smirk is concerned. You see, on the y-axis, we map the implied volatility, and on the x-axis, we map the strike price. Well, not exactly the strike price. We map actually, the scaled strike price. We map the scaled strike price. What does it mean? It means that we take the ratio of the strike price and that of the existing market price. Okay, this is exactly the reciprocal of the S0 by X, which we use for calculating the D1s. I hope you remember that equation. I'm not going to write this equation once again, but let me tell you a few things that you need to understand out here thoroughly. You see, this region that is left to the ATM, this is the ATM region. This region, of course, these are going to be low strike price. These are going to be low strike, and these are going to be high strike price. Okay. Now, in this scaled manner, how do we define this low strike price and high strike price out here? Well, we could do it in few ways. First and foremost is we may assume that this graph actually talks about, since it talks about the strike price, then we can think of that S0 remains constant. S0 is basically your ATM, right? So in this case, if S0 remains constant and K succeedingly actually decreases, the K by S0 factor will become less than 1, because K by S0 factor is equal to 1 at the ATM only, right? This is where the K by S will become 1. Here it is going to be less than 1. Here it is going to be greater than 1. Now, how that can be achieved? There are only 2-3 ways. One is that S0 remains constant and K gradually decreases. So obviously this factor is going to be, as we move to the left of the ATM, this factor is going to gradually go down, which tells us that the volatility is inversely proportional. The implied volatility is inversely proportional to the lower strike price. Another way it can happen is that the K, that is the strike price, decreases, but at the same time, the stock price also decreases. We can interpret in this way also. The only condition being that the stock price decrease is going to be less than the strike price decrease, so that the ratio of K by S still is less than 1. If that happens, then also we are going to get the same result. That is, that as the scaled strike price decreases, the volatility goes up. The volatility goes up. But in this case, the only difference is that along with the strike price, the stock price is also decreasing. So from here, we may conclude that the volatility increases as the stock price decrease. We can conclude from here as well, right? The exact mirror image happens on the right side of the ATM. In this case, what can happen? We can assume that the S0 remains constant and K increases. If K increases, of course, this K by S factor will now become greater than 1 as we move to the right, right? So as we move to the right, one is this. So from here, we may conclude that as the strike price increases, the volatility increases. The volatility increases. Also, we may assume that K increases, but S also increase, but the increase of K is more than increase of X, so that the K by S factor still remains greater than 1. In this case, what we can assume, what we can conclude is that the scaled strike price increases, the volatility increases, but in this case, the stock price increase actually is directly proportional to the implied volatility. Now, what exactly am I trying to prove out here? Well, I'm not going to prove anything out here. I'm just going to explain what your book does not, and regrettably so. All that it means is that we are now faced with a classic contradiction, in that what it tells us is that there are going to be situations where the stock price, that the underlying price is going to be directly proportional and hence positively correlated to the implied volatility. And there will be situations where the underlying stock price will be inversely proportional or negatively correlated with the implied volatility. Both of these theories are actually proven out here. However, please understand that this is only true when we are experiencing a volatility smile. But in case of stocks, what happened? We face a volatility smirk and not the volatility smile. And in volatility smile, what tells us? What does it tell us? It tells us, yes, you've guessed it right, that the implied volatility of the left side is going to be more than the right side. This is my ATM. The implied volatility on the left side is more than the implied volatility on the right side. And in other words, we can say that as the stock price decreases, the implied volatility goes up. That probability or that magnitude is much more than when the implied volatility increases as the stock price increases. Okay, that effect is much less. This is the same curve as that of the volatility smile, with the only difference is the extent or the magnitude of effect. So the magnitude of effect tells us that when the stock price decreases, the implied volatility goes up. That impact is much more than when the stock price goes up and the implied volatility also goes up. Okay, in other words, we can say that the stock price or the underlying price is inversely proportional, or we could say negatively correlated with the implied volatility. This effect or this phenomena is much more prevalent than where the stock price is positively correlated with implied volatility. All right. So if that is so, now let me come to the minimum variance equation also. So minimum variance equation or the minimum variance hedge ratio is basically that ratio which lets us decide how much of a covered call, how much of an underlying asset we should be buying or selling in order to hedge our position. All right. So the delta for the minimum variance hedge ratio under the volatility smile or volatility smirk, which we combine call them the volatility surface, is equal to the delta as calculated from the BSM model, plus there is going to be one more factor, and that one more factor is going to be the Vega factor into the partial differentiation of the implied volatility with respect to the changes in the underlying stock. Now, don't go with the uh, technical jargon of partial differentiation or etc. Just know this, that this is how the delta would be calculated in case we are talking about the delta from a volatility surface perspective and not from the BSM perspective. However, the catch out here is that more often than not, this factor, that is the DE by DS factor, is going to be negative. Why it is negative? Because we just explained that the stock price decreasing will imply that the implied volatility is going up because they are negatively correlated. This is more pronounced than when the stock price increasing accounts for implied volatility going up. That means the stock price and the implied volatility are positively correlated. The first effect dominates the second one. Since it is so, that means this factor is going to be minus. If this factor is going to be minus, we can now take the absolute value and say that the market minimum variance hedge ratio under the volatility surface can be written as the delta derived from the BSM minus the Vega that is there, because Vega is always positive, into implied volatility rate of change with respect to the rate of change of the underlying stock. Okay. Now, with all of this, then we understand that it is just not about the 5 inputs of the BSM model. It is also about the volatility surface change, implied volatility surface change with respect to the underlying movement, and also the time. So when we plot all of them, there are multi-dimensional thing that occurs, and it is just not about the two-dimensional volatility smile or the volatility skew that governs the Greeks or the option prices. Okay, we call this the volatility surface. Practitioners refer to volatility surface and not volatility smile or volatility smirk in particular. And the forces that defines this particular net, I call this a fishing net, that any change along the dimension of these forces will account for a change in the values of the option itself. Okay, so it is just not about the smile, it is just not about the smirk, but it is about the volatility surface, which comprise of all the 5 inputs of the BSM, the time as its new one of the new dimensions, which is also known as the term structure, along with the volatility change with respect to the change in the underlying price. All these 3 factors are important to churn out the implied volatility surface. As I write, any disturbance along the distribution in any dimension can change the shape of the net, thus allowing the net new shape to dominate the old form in the deciding the option price. Okay, so now that we have gotten through this, let's now understand why the option D is correct. So I say option A is ruled out, option B is ruled out, option C is wrong interpretation. By elimination, anyway, D is correct, but D is correct also because I just explained the volatility surface and its importance. Let's revisit this, revisit the problem once again. What does it say? If equity prices and volatilities are negatively correlated, equity price increase will move the option up the existing curve. No, equity price increase will move the option down the equity curve. Remember those volatility smirk? I told you about this. If equity prices and volatilities are positively correlated, equity price increase will move the option curve down. No, it is also not the case. Remember, we talked about the volatility smile. And the third is the minimum variance delta, MVHR, minimum variance delta or minimum variance hedge ratio, one and the same thing, will be higher than Black-Scholes-Merton model in India. This is a debatable topic, I tell you, but in general, this is incorrect because we just saw that the minimum variance delta as derived from the volatility surface is equal to the BSM derived delta plus vega into rate of change of implied volatility with respect to rate of change of the underlying stock. And this factor is always in general is negative because this factor is negative and V is always positive. Hence, obviously, the overall this thing is going to be less than that of BSM model. And thus the answer. And I know that I've taken a very long route to actually explain the whole thing, but unfortunately, your book does not do justice in explaining the whole concept that they should have been. Thank you so much and stay tuned with Charter Series presentation.